So if you're watching this in 2026, the average 30-year fixed conventional mortgage right now is sitting at roughly 6.2%. And so many people still feel like it's really impossible to be homeowners in this current climate. I'm seeing a lot of people still get interest rates under 5% right now. And it's not because they got some magical lender with magical unicorn interest rates. No, it's really because they understood how interest rates are actually priced and they pulled the right levers, and of course they're working with a really good mortgage lenders that allows them to really get those interest rates where it actually makes sense. Now today what I want to do is I want to show you guys 5 legitimate ways to get a mortgage with an interest rate under 5% right now in 2026, and I'm also going to tell you the things that a lot of people just simply ignore, like how much it costs to get a mortgage with an interest rate that low, and really when it doesn't make sense to get an interest rate so low. So right now the average Freddie Mac interest rate is sitting at roughly 6.1%. This is as of early February 2026. So when somebody says you really can't get a mortgage under 6% right now, they are mostly correct, but that's really for a plain vanilla 30-year fixed conventional mortgage with really no strategy. But the thing about mortgages is that they don't really work like a one price item on a menu at a restaurant. They are actually made up of several things, specifically when it comes to the interest rates. And one of the really interesting things about mortgage interest rates is that they are set by roughly 15 different things that make them up. But I don't want to get this so convoluted, so I'm going to tell you 3 things that actually end up making up the kind of interest rate that you end up qualifying for if you're trying to get a mortgage. Now the first one is obviously the market level. So basically we're talking about the things in the economy, things that you really cannot control whatsoever. So I'm talking about mortgage-backed securities, I'm talking about bonds, inflation data, whether the Fed decides to cut or raise interest rates, and payroll reports in the economy, etc. You name it. You guys can't control any of it. And that's exactly why interest rates change basically every single day, and a lot of times interest rates end up changing even multiple times a day. And it's not really because the Fed changed interest rate. Now the second reason why you end up getting the interest rate that you get when you're qualifying for a mortgage is obviously because of your risk profile. So what I do tell people is interest rates are a measure of risk. How risky you are is going to be set what interest rate you also end up getting, coupled with the first thing that I just talked about. Now, if you are a risky person, meaning you have a low credit score, you're obviously going to get a little bit of a higher interest rate. Also, certain loans just simply have lower interest rates than others. So obviously, don't think that just because you have a high credit score, it means that you're going to get the lowest interest rates available. That's not how it works, because in certain loans, you can actually have a pretty bad credit score and end up getting an interest rate lower than somebody with an 800 credit score. Now, the third thing is going to come down to your pricing choices. So basically, the kind of loan that you end up doing and also the terms, whether you do a conventional mortgage versus an FHA loan, VA loan, USDA loan, non-QM loan with bank statements, or if you go with a 30-year fixed, an adjustable rate mortgage, 15-year interest rates, etc. So look guys, I tell you this because your mission is simple. You don't necessarily need the entire market to go to 4% or even 5%. You just need to make sure that you are pricing out the best option for you based on your own personal situation, and that's how you're going to be able to get an interest rate that is much lower than whatever is being advertised right now. Now I want to give you a quick history lesson because keeping things into perspective is so important. Back in October 1981, the average interest rate was around 18.5%. This was the age of super high interest rates, and I'm pretty sure you've heard your parents talk about having 20% mortgage interest rates back then. But now check this out. From 2011 through 2019, interest rates were mostly under 5%. And then obviously everybody remembers the COVID periods between 2020 and 2022 when interest rates went down to as low as 1.5% in some situations. So it goes without saying that a lot of people just get rewired, and then they think that, having low interest rates is just the norm. But as a matter of fact, even though interest rates are around 6% today, that doesn't necessarily make them extremely high. If anything, over the course of the last 100 years or so, interest rates are sort of a little bit under the average. But listen, at the end of the day, the truth is that it's still very hurtful when interest rates right now are still 6%, and obviously the cost of homes has just gone up so much. But if anything, what I want you to get out of this video is really, can you structure your deal intelligently and in a way that is going to make sense for you so that you can get the lowest interest rates available? Okay, now let's talk about those 5 creative ways to get an interest rate under 5% right now, with the first one being probably the most plain vanilla one, is not to do a 30-year fixed mortgage and instead do a 15-year loan. So here's the thing, 15-year mortgages, because you are paying them so much faster, they are actually priced a lot lower than a 30-year loan. And just kind of think about it. When you go to the bank and you ask your lender or your bank, obviously making things a little bit easier to understand, you're telling the bank to give you a loan that's fixed for 30 years. Obviously, in order to hedge those funds, they're going to give you an interest rate that's going to be higher because the repayment period is so much longer. But if you go and just get a loan that's fixed for 15 years, then obviously you're just going to go ahead and pay your loan a lot faster, which, by the way, brings me back to the last thing that I just said, which was risk. It's a lot riskier for a bank to just collect money over 30 years versus 15 years. And that's the reason why 15-year interest rates are so much better than 30-year interest rates. Right now, the Freddie Mac index for 15-year mortgages is an interest rate of roughly 5.44%. But I'm seeing people right now actually have the ability to buy down those interest rates to as low as 4.875% with obviously discount points. Of course, it's going to be up to you if discount points make sense or not. But for somebody who is actually looking to pay off their homes in full, probably paying to get a lower interest rate might actually save them a little bit of cash. Now, obviously, make sure that you do the math, sit down with your mortgage broker and have them really show you all the numbers. Now, listen to this. If you are looking to refinance right now and you're coming from a high interest rate like 7-8%, and you're obviously looking to get into a much lower interest rate, one thing that I will definitely encourage you to do is to consider doing a 15-year mortgage, because if you are already accustomed to making the high payment that you're making based on your current interest rate over 7%, and maybe you already pay PMI, then you may be able to get down to a 15-year term with a much lower interest rate, which is going to probably put you into the same payment that you have already, but you are going to be able to save a lot of money on interest, while at the same time pay down your loan so much faster. Okay, so here's the second method. Instead of doing a 30-year fixed mortgage, which in real reality most people should not really do, go with an adjustable interest rate instead. Now, of course, a lot of people, when they hear the word adjustable rate mortgage, they just freak out completely. But that's honestly because they don't necessarily understand how adjustable rate mortgages work right now, especially in 2026. The reality is that adjustable rate mortgages are also fixed interest rates. They're just not fixed for 30 years. They are still 30-year loans, but they are fixed for 5 or 7 or even 10 years. And these adjustable interest rates are going to get you much better rates than a 30-year fixed mortgage. And right now, while you can get a 30-year fixed mortgage at roughly 5.8%, 6%, you can get an adjustable rate mortgage to price at roughly 5% or even less if you pay discount points. And of course, also depends on what kind of lender you end up going with. Okay, now let's talk about the third method, and that's going with a government type of mortgage like an FHA loan or a VA loan if you're a veteran. Now, here's the thing, guys. FHA interest rates are going to be lower than 30-year fixed conventional mortgages because FHA is a program that is insured by the federal government, so those interest rates are going to be a little bit lower. Right now, the average 30-year fixed FHA mortgage is sitting at roughly 5.8%. However, you can get down to a very low 5% interest rate by paying discount points. Once again, do the math and see if it makes sense for you. Now, what I don't want you to do is to consider doing an FHA mortgage over a conventional mortgage if you are a well-qualified person just because of the low interest rate. Because as a matter of fact, even though conventional mortgages might have higher interest rates compared to FHA loans, you are actually going to pay less on a conventional mortgage, and the fees are going to be considerably lower compared to an FHA loan. And the reason why, it's because with FHA, not only do you pay PMI every single month for the rest of the life of the loan, but also you pay a one-time PMI premium, which is 1.75% of your loan amount, which can be a lot of money. So only do an FHA loan if it really makes sense. Don't take an FHA loan over a conventional mortgage if you can actually do a conventional loan instead. Okay, here's method number 4, and that is doing an FHA loan, but instead of doing a 30-year fixed, do a 5-year fixed interest rate on the FHA mortgage, so basically an adjustable rate mortgage for an FHA loan. But if you think about it, doing an adjustable rate mortgage on an FHA loan makes a lot of sense. And the reason why I say that, it's because hopefully you don't keep this FHA loan forever. You don't want to, because once again, you're gonna be paying the PMI. The PMI is gonna be extremely expensive. And as your home gains value, you obviously want to get out of this FHA loan so that you can refinance into a conventional mortgage, get rid of the PMI, and there we go. So theoretically speaking, you don't want to keep this FHA loan for more than 5 years anyways. And listen, as a mortgage broker myself, and I do a lot of FHA loans for my clients, especially first-time home buyers, I do tell them that, of course, they don't want to spend too much time into this loan. If anything, FHA should just help you, should be a loan to help you get in the house, but it's not a loan that you want to keep forever, because once again, the PMI is going to eat you. Okay, now the fifth method is doing a VA loan. This is for you guys who are veterans. And once again, don't do a 30-year fixed VA mortgage. Instead, look into doing an adjustable rate mortgage. Adjustable rate mortgages carry lower interest rates. And right now, with a VA mortgage, which is one of those loans that can get you the best interest rates in this market, or at least very close to the best interest rates in this market, a 5-year adjustable rate mortgage on VA will put you at roughly 4.875%, 5%, depending on what kind of lender you end up going with, and obviously based on the kind of credit scores that you might have. Okay, now let's talk a little bit about pain points, because obviously in order to get down to these super low interest rates under 5%, truth is, you're gonna have to pay discount points in order to achieve them. Basically, if you are gonna buy down the interest rate with discount points, the longer you stay in your mortgage, the more you are going to save. Now, on the other hand, if you end up buying a lot of money on discount points because you got attracted to such a low interest rate, but then rates end up going down in a year or two, and you end up refinancing, then all you're gonna do is you're gonna lose the money that you paid on your discount points. So it doesn't make a lot of sense. So obviously nobody's really gonna know whether interest rates go up or down, but if you feel like interest rates might go down in the future, then perhaps the best thing for you is just to stay with an interest rate without paying any discount points, and then take advantage of refinancing down the road when interest rates are a lot better. Okay guys, that's all I got for you today, but do let me know in the comments if you have any questions about any of the stuff that I talked about on how to get these super low interest rates. And as always, my information is going to be in the description box of this video, so feel free to reach out to us. We'll be more than happy to put together something for you, or at least kind of show you and share with you what kind of things make sense for you based on these interest rates. And if you like this video and you kind of found something really interesting, I do appreciate if you give us a like and subscribe to the channel, and I will see you guys on the next one. Thank you for watching.